Hey, what's up everybody? It's your mortgage expert here, Brian McCauley. So you're looking to buy a house in Dallas, Texas. You're worried about these high interest rates and you're trying to find a way to get your rate and your payment lower? Stick around. I'm going to show you 3 different options in this video to make that happen. So listen, we all know the housing market is cooling off in the buyer's favor. You know, the good news is inventory is becoming available and buyers are able to get a deal on a property, get some concessions, but even get a house that they potentially like. You know, the bad news is these interest rates now are moving up into the 7s and the 8s. So what I wanted to do today is I wanted to show everybody out there to not be as concerned about high interest rates as they are right now, because everybody's concerned that, hey, my payment and my rate's gonna get out of control, and I'm just really worried about that. So what I wanna talk about today is there's 3 different type of interest rate buy-down products that allow you, the buyer, to get your interest rate much lower than what the current market is offering. I wanna talk about strategy in option 1, okay? Strategy in option 1 is what's called a permanent buy-down interest rate option. So interest rates always come in 3 forms: a natural rate, which is a par rate, which is what somebody qualifies for. You get a premium rate, which is take a higher rate than what you qualify for, and the lender will give you a credit back for like closing costs or something. Or you can take a discounted rate, and a discounted rate is a lower rate than what the market currently offers, but it costs money. So this is always available. It hasn't been very popular during the COVID run because interest rates are in the 2s and the 3s, and there was no reason to buy it down. But the key main thing when it comes to an interest rate buy down is, you know, it's not a smart idea for the buyer to pay that money, but it's a tremendous idea and a great strategy in today's market when you can get the seller to buy the rate down for you permanently. So what do I mean? So let's give an example of a $500,000 house. Let's use a hypothetical, but kind of around where today's market is at 7.5%. People are saying, man, that's just way too high. It's gonna make my rate too high, my payment too high. Brian, I don't want that. So let's say that the client's ideal target rate and target payment is 5.5%. So if they're buying a $500,000 house, the current market is at 7.5%. They want their rate at 5.5%, and that's where they want their payment. What we can do is do a permanent fixed rate buy down. So what that looks like is you would come to me, I would run a total cost analysis and say, hey, the difference of 7.5% to 5.5% on the interest rate would cost you hypothetically $25,000 to get that interest rate down, okay? So what you and your realtor would do is you would go to that homeowner and say, hey, I'm happy to give you $500,000 for your house, but I need $25,000 in closing cost. And what'll happen is we'll use that $25,000 in closing cost to buy that interest rate down from 7.5% to 5.5%, saving the client over $400 a month on the payment. That is a great strategy on a permanent fixed buy down where the seller pays all the money to get the rate back to where the clients want it, and that way it's a much more advantageous way to take the concession versus off the price of the house. So that is option number 1, is a permanent fixed rate buy down, example 7.5% to 5.5%. So the second and the third options are both what are called temporary interest rate buy downs, and I want to talk about those right now. So there is a 2-1 temporary buy down and a 3-2-1 temporary buy down. So let's talk about option 2, which is a temporary 2-1 buy down. So it costs more money to do a permanent fixed buy down than it would a temporary. So a 2-1 buy down simply means this: you can get some money from the seller and you buy your interest rate down 2% lower than what the current market is for the first year, and then 1% lower than what the current market is the second year. And then starting on the 3rd year, the interest rate will begin at what today's market is. So if today's market is 7.5 and you do a 2-1 buy down, that means year 1, your interest rate would be 5.5. Year 2, your interest rate would be 6.5, and then year 3, your interest rate would start again at 7.5, and it's fixed for the life of the loan. So a couple pros and cons on that for people out there that are watching this and saying, well, why should I do a permanent versus a temporary? Again, number 1, the cost to buy down the interest rate from 7.5 to 5.5 on a permanent fixed is probably almost twice as expensive as it is to do a temporary. So if you've got to use some money or get some money from the seller, where you may have to get $25,000 to buy it down permanently, you may only need 12, 13, 14, 15 to buy it down temporarily. And people will say, well, I don't want my interest rate, 5.5 or 6.5 just for, a year or two. I want it for the life of the loan. So that's where you have to make the decision. You know, the other key component about a 2-1 temporary buy down is a few things. Number one, most people are probably going to refinance in the next 12 to 24 months when the interest rates drop. So if those interest rates drop and they naturally come down below where the current market is at 5.5 or 6.5, wherever you buy the rate down, you're going to refinance anyway. So you're probably not going to keep that loan for a long period of time. The second cool thing about a temporary buy down is actually when we get that money from the seller and we close, we hold that money here at the mortgage company and we don't use it all right away. We use some of it to buy the interest rate down for the first year. And at the end of the 12 months, we use some of it and the rest of it to buy the interest rate down to the lower rate for the second year. Now, if you refinance, sell, or you pay off the home, whatever's left over out of the money that we got from the seller at the beginning when we closed, you as the consumer get that back. I think that's a big bonus for people to understand that, hey, you're probably not going to keep the property or the loan forever, so you don't need a permanent fixed buy down unless it's a really, really good deal and you buy it really, really low, which would cost a lot of money. And it's possible to get that much money from the seller, but right now, you know, getting somewhere 2% lower is kind of the average of where people are getting concessions. But again, if you get that, you can stay with option one. Option two on the 2-1 buy down is you can get your rate lower as a starting rate for year one and year two. And then of course you can refinance, or you can figure out if you want to stick with the rate that's there after that 2-1 expires, okay? Plus it's half the cost. And if you do anything before that term is up on the buy down, the 2-1 and the first year and the second year, you get some of that money back, right? Okay. So the 3-2-1 buy down is the same concept as the 2-1 buy down, but as opposed to doing 2% lower for the first year and then 1% lower for the second year, this is actually 3% lower than the current market on the first year, 2% lower than the current market on the second year, and then 1% lower than the current market on the third year. And then of course, year four, obviously it would mature back to the current market. So the example on that for a 3-2-1 buy down is if today's current interest rate is 7.5% and you want to do a 3-2-1 temporary buy down, you would buy the interest rate down from 7.5 to 4.5 on year one. And then year two, it would go to 5.5%. And then year three, it would go to 6.5%. And then year four, it would mature to what today's market is at 7.5% and stay there for the life of the loan. So the biggest difference between the 3-2-1 temporary buy down and the 2-1 temporary buy down obviously is the cost to get the cheaper rate. So that's the other component we have to figure out when talking to the seller, when working with your realtor, to figure out how much money can we get from the owners of the property. That will ultimately dictate how much concession you get as the buyer, and then of course what we want to do with it. So if we get a lot of money, we can do a temporary buy down of a 3-2-1. If we get a little bit of money, we can do a temporary buy down of a 2-1, or you can always again do the permanent fixed buy down, so that way your interest rate drops down and stays there for the life of the loan. It just depends on the specifics of how long you're going to be in the loan, how long you're going to be in the property, what the market's going to do in the future, and really how much money we get access to from that seller. So there are a lot of strategies, a lot of options out there, but I want to make sure that buyers out there understand the bottom line is you can get a much cheaper interest rate than what the current market is offering, up to 2 or 3% lower. It's called a buy down. It does not make sense for you, the buyer, to pay for it, but if we can get the seller to pay for it, then obviously they pay for all the concessions, they pay to buy the rate down, you get the house that you love, you win the offer that you're trying to get, and they spend all of their money buying your interest rate down back to where things were 6 months ago, so that way everybody's happy and it's a win-win. So hopefully you found this video valuable. If you did, do me a favor, like, subscribe, even comment below. Myself or my team promise to get back to you. And even if you just want to set up a consultation to talk about the housing market, your current financial situation, maybe just see if you can get pre-approved to talk about what the future holds, do us a favor, call us, email us, text us. We're always here for you. Until next time, stay tuned.